imagine wiring like $350 in cryptocurrency to just some random wallet address you found on a PDF.
Right, which sounds totally normal and incredibly safe.
Oh, yeah, a completely standard financial advice here. But in return for doing that, you actually become a landlord.
A landlord. Okay.
Yeah.
But your tenants aren't exactly, people.
No, they're definitely not people. They are 10,000 lobsters swimming directly beneath a floating hotel room in the Philippines.
It is just, it's the ultimate collision of decentralized internet money and like highly tangible, wet biological reality.
Right. Today, we are tearing apart a document that proves the wildest frontier of real estate isn't even on land anymore. It is quite literally bobbing out in the open ocean.
Yeah, you are looking at a pitch that completely bypasses, every traditional bank, every zoning board. It goes straight to anyone with a smartphone and a digital wallet.
Welcome to the deep dive. So if you're sitting in traffic right now, or maybe renting an apartment, the idea of owning waterfront property for like less than a car payment probably sounds like an absolute dream.
Oh, for sure. It's the ultimate fantasy for a lot of people.
Exactly. So today we are taking you on a journey into a highly unusual real estate and hospitality pitch to see exactly what that dream entails. We've got our hands on this promotional document and a really extensive FAQ for a project called Reef Resort ArcPad.
And it is quite a document.
It is massive. Okay, let's unpack this. Our mission today is to dissect this single source to try and understand the completely bizarre intersection of luxury tourism, aquaculture, fractional real estate, and alternative crypto financing.
Yeah, what we have here is just a fascinating blend of utopian ecotourism and these highly granular, frankly, somewhat baffling investment mechanics.
Baffling is definitely the word.
Right. So we are going to help you navigate both sides of this. We have the idyllic promises, like the really beautiful pictures, the text paints of this floating oasis, and then we have the intricate financial fine print.
The fine print is where it gets crazy.
Oh, absolutely. Because this document is trying to tell two very distinct stories at the exact same time,
Okay.
and where those stories overlap, well, that's where the real friction happens.
Let's start with the physical vision they are selling, right? Because it is very vivid. The document actually calls Reef Resort a, quote, fully integrated aquatic ecosystem.
The fully integrated aquatic ecosystem. That is, that's a phrase doing a lot of heavy lifting.
A ton of heavy lifting. It's not just a hotel. It explicitly lists that it functions as a fish and lobster farm, a floating aquarium, and a waterfront property, all sort of rolled into one single structure.
Which is wild, because historically, agriculture and leisure are kept strictly separated.
Yeah, for obvious reasons.
Right. A commercial fish farm usually brings to mind very industrial, utilitarian imagery. You think of the smell, the noise, heavy machinery. It's not exactly a vacation destination.
No, definitely not.
But they are actively trying to elevate that concept here. They want to merge the agricultural utility of a lobster farm with the high-end, pristine leisure of a floating villa. They're branding it as this closed-loop, sustainable utopia.
It's essentially like living inside an upside-down fish tank. The document heavily highlights these overwater rooms that come equipped with an optional glass bottom.
Oh, right, the glass bottom feature.
Yeah, and they lean so hard into the visual experience of that. They claim they will have a better built-in aquarium than anywhere in the world. Because as a guest, you can literally watch, and I'm quoting here, tens of thousands of fish swim in circle beneath your feet during feeding time.
Which, from a marketing perspective, is a brilliant psychological hook.
It really is.
They are taking the traditional appeal of a glass-bottom boat,
Yep.
which, if you've ever been on one, it's usually this transient, maybe hour-long tourist activity where you just kind of hope to catch a glimpse of a passing turtle.
Right, mostly you just see some cloudy water and maybe some kelp.
Exactly. But they're taking that concept and making it your living room floor. You aren't just observing wild fish passing by chance. You are observing the highly concentrated feeding time of a massive aquaculture operation right beneath your sofa.
It guarantees a visual spectacle. You don't have to get lucky.
Exactly. It's a guaranteed show.
Tens of thousands of fish. The scale is just massive. But while you are sitting directly over this industrial-scale fish farm, the text makes sure to emphasize that you are definitely not roughing it.
Oh, no, not at all.
You aren't pitching a tent on a rickety wooden raft. The document explicitly promises modern amenities at sea. It mentions a dedicated connection to a solar electric grid, access to a strong Wi-Fi network, and 247 air conditioning.
And this is crucial, I think, to understanding their target demographic. What's fascinating here is how they are trying to eliminate the traditional trade-offs of remote ecotourism.
Right. Usually it's one or the other.
Exactly. Normally, if you want to be completely immersed in a pristine natural environment,
Right.
you sacrifice connectivity. You sacrifice climate control.
You sweat a little, you get eaten by bugs, you ignore your emails.
You deal with it because you're in nature. But this pitch looks at the modern consumer and says, no, you don't have to compromise at all. You can have the untouched ocean experience while maintaining total digital and physical comfort.
Constant air conditioning while floating on the open ocean? I mean, just from an engineering standpoint alone, that is a massive energy load, which we'll definitely get into later.
Oh, we have to talk about the power grid later. It's a huge factor.
But let's look at the activities first. The text says guests can partake in, quote, in-resort fishing. So you don't even need to charter a boat and go far out to sea to reel in a big catch. You literally just drop a line directly from the resort.
Which is incredibly convenient.
Super convenient. Plus, they offer scuba diving, snorkeling, and boat rides.
They are essentially building a completely self-contained destination. You don't leave the resort to go on an excursion. The resort itself is the excursion.
It's very much a cruise ship mentality.
Yeah, exactly like a cruise ship, but applied to a stationary or, well, at least tethered platform.
Right, tethered. Which brings us to where this floating ecosystem is actually anchored. The document maps out the geography with extreme specificity. It is located off the coast of Samal Island, near Davao City, in the Philippines.
And the way they describe the views from that specific location is a huge part of the sell.
Oh, it's everything.
It's the 360-degree marketing claim, which, geographically speaking, is quite clever.
It's brilliant. The text breaks it down perfectly. To the east, you have the lushness of Samal Island. To the west, you have a view of Mount Apo, which is the highest mountain in the country. To the north, you can see the urban Davao City skyline.
So you get the city lights at night.
Exactly. And then to the south, you have the wide open expanse of the Celebes Sea. The document literally says, quote, beautiful views, sunrise and sunset, 360 degrees around. You have never seen waterfront property like this.
If you think about traditional real estate marketing, they are leveraging this specific geography brilliantly.
How so?
Well, a traditional multi-million-dollar waterfront property only has one front, right? You face the water and your back is to the road or a cliff or your neighbor's fence.
Yeah, you get one good view out the front window.
Right. But by situating a floating structure in this specific strait, Reef Resort is essentially claiming 4 different fronts. You get the urban skyline, the local island, the massive mountain peak, and the open ocean, all from a single swivel chair in your living room.
It sounds like a geographical jackpot. Just stunning. But the absolute second you mention a floating structure permanently moored in the Philippines, a very specific, totally undeniable reality comes to mind.
The elements, the weather.
Exactly. Building a floating, glass-bottomed fish farm hotel sounds like a complete utopian dream right up until a Category 5 storm rolls in. We are talking about a region globally recognized for extreme weather events.
And the document entirely anticipates this concern. They actually dedicate a massive portion of their FAQ section specifically to addressing natural disasters.
They really do.
And the way they construct their argument is kind of a masterclass in using regional geography and ocean physics to reassure a potential buyer, especially a buyer who might be sitting in a safe, landlocked office halfway across the world.
So let's break down exactly what they claim, because honestly, the claims are bold. Let's start with typhoons. The text claims the specific region around Samal Island is completely insulated from typhoons.
Insulated is a strong word.
Right. The reasoning the document provides is that typhoons in the Philippines generally tend to only form north of the island of Mindanao. And since Samal is located all the way down at the southern tip of Mindanao, they claim they are entirely safe from direct hits.
They are relying heavily on historical climatology here. They're essentially telling the investor, yes, the country of the Philippines has typhoons, we admit that, but our specific microregion does not.
It's like a magical weather bubble.
It's a geographical defense mechanism. They are betting on historical weather tracks to provide this invisible shield over the property.
Okay, moving down the disaster list. Earthquakes. Now, the Philippines sits right on the Pacific Ring of Fire, very active seismic zone. But the document simply states, quote, earthquakes cannot affect structures floating on water.
Wow.
Yeah. Therefore, they conclude, the location is, quote, much safer than a normal city in the event of an earthquake.
This is an interesting, though highly simplified application of physics to real estate marketing.
Highly simplified. Yeah.
In a terrestrial city, an earthquake is devastating because the rigid foundation of a building is violently shifted by the Earth's crust, right? The ground moves, the building cracks.
Right, it shatters.
But on the water, the liquid ocean acts as the ultimate shock absorber. The seismic waves moving through the bedrock do not transfer into the liquid water in a way that would shatter a floating platform bobbing on the surface.
Wait, immune, I have to push back on their phrasing there.
Yeah.
What about the mooring lines holding the resort in place? I mean, what about the underwater cables connecting them to the mainland power grid or the internet?
That is a very valid point.
Like, an earthquake might not shatter the water itself, sure, but it sure as hell triggers landslides on the coast right next to them, or violently shifts the seabed where their anchors are actually drilled into the rock.
And that is the exact analytical leap the document hopes you do not make.
Ah, they want you to just think about the floating box.
Exactly. They focus entirely on the floating structure itself, completely isolating the room from the complex infrastructure that keeps it tethered and operational. Sure, the platform might survive the shaking, but if the anchor lines snap or the mainland infrastructure goes down, the integrated ecosystem fails completely.
And that leads perfectly into their biggest defense, tsunamis. The document does acknowledge that tsunamis are a reality in the Pacific, though they say they are extremely rare. But their defense mechanism for this is fascinating.
It's all about the wave dynamics.
Right. The text claims that tsunamis are essentially large waves that build energy over long distances, and they only actually, quote, break when they near land. Therefore, they claim, floating structures sufficiently far out at sea will simply, quote, harmlessly roll over tsunamis.
Think of it like a cork in a bathtub.
Okay, a cork.
If you push a massive wave of water through the deep end of the tub, the cork doesn't get smashed. It just bobs up, rides the swell, and bobs back down. The wave energy is distributed through the vast depth of the water column below it.
It just glides over it.
Exactly. And the physics they are citing are broadly accurate for deep ocean waters. A tsunami wave passes underneath a deep-sea oil rig or a cargo ship out in the ocean, and often the crew doesn't even realize it's happening.
Wow, really?
Yeah, it's just a broad swell. It only becomes a towering, destructive wall of water when that fast-moving wave hits the shallow coastal continental shelf. It basically runs out of deep water, trips over the rising seabed, and has nowhere to go but up and forward onto the land.
Right. The wave literally trips over the coastline.
Exactly. So the document argues that because they are a floating structure, positioned out in the deeper water away from the breaking point of the shoreline, they will just bob up and down harmlessly as this massive kinetic energy passes underneath them.
So they're safer than the mainland.
That's their pitch. They are pitching that it is actually the traditional coastal real estate, the multi-million-dollar beach houses that are in mortal danger, not the floating lobster farm.
Okay, honestly, that sounds highly engineered and very reassuring. But reading the text itself, there is a glaring contradiction.
Usually.
If the geography of Mindanao is so perfect, right, and the physics of floating structures make them essentially impervious to earthquakes and tsunamis,
Right.
then why does the document include a very specific operational clause right after all these bold assurances? It states, and I am quoting here, "In the event of extreme weather, however, even if not posing an immediate threat, the resort will be preemptively evacuated."
And that right there is the ultimate tension of this entire document.
It totally undermines everything they just said.
Exactly. You have the marketing language aggressively pitching invulnerability. They're selling you an indestructible, physics-defying fortress on the water. But then you have the operational fine print, which reveals a very necessary liability-driven pragmatism.
It's literally like the captain of the Titanic saying, the ship is mathematically unsinkable. The physics completely prove it. Oh, and also, here's a highly detailed mandatory schedule for life raft drills.
Precisely. The evacuation clause demonstrates the stark difference between selling a dream and managing actual human risk.
Because it is a huge risk.
Huge. No matter how perfectly you explain the physics of deepwater tsunami swells or historical typhoon storm tracks, keeping human beings floating on a platform in the open ocean during a severe weather event is a catastrophic liability.
You just can't do it.
The management knows this. They have to promise total architectural safety to get your investment capital in the first place. But they absolutely have to mandate preemptive evacuation to appease their insurance adjusters and manage the actual physical reality of the ocean.
Which makes complete sense if you are actually running a hotel. But it's a stark reminder to the investor that this isn't just some abstract digital asset on a spreadsheet. It's a physical, vulnerable thing sitting in a highly dynamic, totally unpredictable ocean environment.
Right. It's in the real world.
So they've pitched this incredible off-grid fortress, but building a self-sustaining floating city isn't cheap. Usually, a developer takes a blueprint to a massive commercial bank, secures a $100 million loan, and builds the thing.
The traditional route.
Right. But here, they are bypassing the banks entirely and going straight to the internet, which introduces a whole new kind of turbulence.
And this is where the document transitions from a glossy, fun travel brochure into a highly complex, frankly labyrinthine financial pitch.
It gets so messy here. They are not selling you a room, not in the traditional sense of a timeshare where you get like week 14 every single year. They are utilizing a fractional ownership model, and the tiers they offer are incredibly granular.
Granular is putting it mildly.
Yeah. Here's where it gets really interesting. You don't have to buy a whole unit. You don't even have to buy 10% of a unit. You can buy as little as 0.75%.
Less than 1%.
Less than 1% of a floating room.
Is the ultimate fragmentation of real estate. They are lowering the barrier to entry so drastically that almost anyone with a tiny bit of disposable income can look at a PDF and call themselves an owner of an international resort.
Which is a crazy psychological hook.
It completely taps into the desperation of modern real estate markets. I mean, think about it. When a starter home on land costs $500,000 at 7% interest, the idea of property ownership feels entirely out of reach for millions of people.
It's impossible for a lot of people.
So this model kind of gamifies real estate. It offers the psychological thrill of investing and owning a real physical asset, but at the price point of, like, a new video game console.
But trying to figure out what that tiny fraction actually costs based on this text is, well, it's a journey. Let's look at the price lists provided in the source, and I strongly emphasize lists, plural.
The conflicting price lists are perhaps the most baffling and yet revealing part of this entire document.
Okay, so I'm looking at it right now. The document presents a section prominently titled Become an Owner. Please make a payment by selecting one of the options below. And then it gives us the first list. It starts at $350 for that 0.75% ownership tier.
Okay, $350.
Right. And for that $350, it says you get shared ownership and 2 nights free stay. Then it scales up perfectly logically. 1.5%, 3%, 6%, 12.5%, 25%, 50%, all the way until you hit 100% ownership. The top full ownership tier costs $40,000, grants you exclusive ownership, and gives you 10 nights free stay.
Simple enough on the surface. It's a clear, tiered system. You pay your one-time fee, you receive your mathematical fraction of the unit, and you get some free vacation nights as a perk based on your investment level.
Right. It makes logical mathematical sense, but literally right below that list on the very same page, there is a second list. And the prices are exactly the same.
Exactly the same.
Yes, 0.75% is still $350. The 100% tier is still $40,000.
Yeah.
But the perks attached to those prices are completely different. In this second list, every single tier, from the tiny $350 microscopic fraction all the way up to the $40,000 full ownership, grants the exact same perk.
Which is what?
1 week free stay in Reef Resort.
Which logically makes absolutely no sense from a business or consumer standpoint.
None at all.
Why would someone laying out $40,000 receive the exact same 1 week free stay as someone paying $350? And why does this list directly contradict the list immediately preceding it on the exact same page?
It's totally baffling. Like, I read it 3 times to make sure I wasn't losing my mind, but just hold on, because it gets crazier. Immediately after that second list, there is a third list.
The third list, of course.
And this one introduces a massive financial curveball. It says $430 monthly for the 0.75% tier, and it scales up. 1.5% is $800 monthly. 100% ownership is listed as $46,800 monthly.
And we have to stop here and highlight the profound internal contradiction of the text.
Yeah.
Because later, in the very same FAQ section of the document, there's a specific question posed.
Oh, I know the one you mean.
It asks, is this a monthly premium or one-time only? And the provided answer is emphatically, and I quote, this is not a monthly cost. This is to buy permanent ownership.
So, just to be totally clear, they have a price list explicitly labeling the costs as monthly, scaling up to nearly $50,000 a month for a single room, and then an FAQ paragraph explicitly stating there are no monthly costs.
This raises an important question about the nature of the source document itself. What are we actually reading here?
Right, like, Did anyone proofread this before asking people for 50 grand a month?
It reads very much like a living, unedited draft document. It feels like we are looking directly into the internal hard drive of a developer who was actively brainstorming different pricing models in real time.
Like a scratch pad.
Exactly. Maybe they thought about a one-time fee model with scaling nights. Then maybe they thought about a one-time fee model with a flat week for everyone. Then maybe they explored a monthly installment plan.
And they just kept all of them.
Right. Instead of deleting the old rejected ideas, they simply published all of them on the same promotional page. It blends multiple iterations of a sales pitch into one highly confusing, contradictory stream of consciousness.
It totally does. It feels like you're reading their rough notes, but just when you think you've figured out the fiat currency confusion, the document throws you into the deep end of the cryptocurrency pool.
Oh, the crypto section.
Yeah. The final sections of the document, under the heading Pay for Ownership, ask the reader to, quote, copy the code below. And they provide these massively long alphanumeric strings. One starts with BC1Q and another starts with 0xB.
Those are cryptocurrency wallet addresses. For anyone listening who is unfamiliar, the BC1 prefix is typical for a native SegWit Bitcoin address, and the 0x prefix is the standard identifier for Ethereum and Ethereum-compatible blockchain networks.
So they are explicitly directly soliciting cryptocurrency for these fractional real estate shares. And under these wallet codes, there are completely new price lists.
New lists. Unbelievable.
Yeah. The first crypto list says 0.75% is 9,600 Philippine pesos, or about $165. Then just a few lines down, there's another list that says 0.75% is 20,800 pesos, or $350. Then yet another list where 0.75% is 19,500 pesos, or $330.
It is absolute pricing whiplash.
Whiplash is the perfect word for it.
And it fundamentally changes the nature of the investment. We have to unpack the underlying mechanics of what is happening here. When you buy traditional real estate, you use an escrow company, right?
Right. A title company, lawyers, the whole nine yards.
Yeah, exactly. A neutral third party holds your money, verifies the deed, ensures the title is clean, and then legally transfers ownership through the government.
Right. There is a massive paper trail and a huge legal safety net.
Here, by asking you to copy a hex code and send Ethereum directly to an anonymous wallet, they are completely bypassing the legal and financial safety nets of traditional real estate. They are entering a massive legal gray area.
Huge gray area. Like, what do you even own?
Does the blockchain transaction act as the deed? If their server goes down, or if the founders just lose the private keys to that wallet, do you still legally own 0.75% of a room in the Philippines? The document doesn't explain the legal mechanics of how a string of digital code sent over the internet actually translates into an internationally recognized property right over a physical lobster farm.
Because it probably doesn't. You literally have fiat prices, crypto prices, monthly prices, one-time prices, all for the exact same tiny fraction of the resort, all sitting right next to each other on the page.
But, despite the absolute chaos of the text, the inclusion of those cryptographic wallet addresses signals a very specific target audience.
Who are they going after?
The intent is clear. This investment is targeting tech-forward, decentralized finance participants, crypto natives.
The Web3 crowd.
Exactly. People who are completely comfortable copying a 40-character hex code, sending digital assets into the ether without a bank's permission, and receiving a fractional ownership stake based entirely on the trust of a PDF. It is a wild amalgamation of Web3 financing and tangible hospitality.
It really is the Wild West of real estate. Okay, so let's play this out. Let's say you manage to pick a price. You navigate the maze of lists, you send your crypto or your fiat, and you officially own 0.75% of a room.
Okay, you're an owner.
Right. The natural next question is, how do you actually make money? What is the ROI, the return on investment, that justifies taking this leap?
And thankfully, the document does actually provide an income opportunity calculator.
Yes, it does.
Though, like everything else we've looked at today, it requires some very careful parsing and a really healthy dose of skepticism regarding their baseline assumptions.
Oh, definitely. Okay, let me put on my accountant hat and walk you through the exact math they provide in the text. They frame this as a, quote, conservative estimate based strictly on weekend bookings. First, the basic parameters. They set the exchange rate at $1 to 55 Philippine pesos. They assume a heavily discounted nightly rate for the room of $60, which comes out to 300 pesos.
We should pause on that figure just for a second. $60 a night for a brand new luxury floating room with 247 air conditioning, high-speed Wi-Fi, and a glass bottom looking over a private fish farm. That seems incredibly low for the international tourism market.
It does seem really cheap.
But that actually does support their claim that this specific estimate is conservative. They aren't projecting pie-in-the-sky $1,000 a night luxury rates for this baseline calculation.
Very conservative. So at $60 a night, they estimate 8 bookings a month. Basically, they are assuming the room only rents out on Friday and Saturday nights. That gives us 96 bookings a year. So 96 bookings times 3,300 pesos gives us an annual gross income of 316,800 pesos.
Yeah, but as any property owner knows, gross income is a fantasy. You don't get to keep all of that.
Right, no one keeps gross. The document mandates a flat 30% deduction right off the top for estimated expenses. They list this as covering utilities, maintenance, marketing, and general upkeep. That takes away 95,040 pesos, leaving us with a net income of 230,760 pesos.
And here's the crucial mechanic of the investment, right? This is the real hook for the buyer. How is that net income divided between the management and the investor?
The text outlines a revenue split. 92% goes to the unit owner and 8% goes to Reef Resort management. So in this example, the unit owner gets roughly 204,019 pesos, and the resort gets about 17,740 pesos.
At a glance, a 928 split heavily favoring the owner seems almost unbelievably generous.
It sounds amazing, right?
It does. Most traditional property management companies, especially for short-term vacation rentals, take a significantly larger cut, often 20 to 30% just for handling bookings and cleaning. Taking only 8% to manage a floating structure with live aquaculture underneath it is incredibly low.
But here's where we really need to run the numbers for you, the listener. How does this scale down for the micro-investor? Because the document gives us the math for the unit owner. Singular, as in someone who bought the whole room for $40,000.
Right, the full owner.
But we just spent a massive amount of time talking about how you can buy 0.75% of a unit. If I own less than 1%, am I getting 0.75% of that 92%?
That is the logical assumption required by the fractional model, yes. It has to scale that way.
Okay, let's do that math right now. 0.75% of 204,019 pesos is roughly 1,530 pesos. Divide that by their stated exchange rate of 55, and my annual return on my microscopic fraction is exactly $27.81. Let's just round up to 28 bucks.
$28 a year.
And remember, depending on which confusing price list I used, I paid somewhere between $165 and $430 for that tiny fraction in the first place.
Let's contextualize that yield versus the risk. If you paid the $350 price, a return of $28 a year is exactly an 8% annual yield, which honestly sounds decent compared to a standard bank savings account.
Sure, 8% isn't bad.
But look at the timeline. It would take you 12.5 years just to break even on your initial $350 investment. And that 12.5-year timeline assumes the resort operates exactly as this conservative estimate outlines every single year.
With zero hiccups.
Right, with zero inflation, no massive spikes in the cost of Philippine energy, no catastrophic maintenance failures, and absolutely no preemptive weather evacuations that might wipe out a month of bookings.
Right. If a typhoon comes through and damages the main solar array, your little $28 annual profit is wiped out instantly by emergency maintenance assessments. And importantly, the text itself doesn't explicitly do that final fractional math for you.
No, it leaves that out.
It shows the big, flashy numbers for the whole unit and leaves it entirely up to the reader to extrapolate their specific microscopic earnings.
It relies heavily on the psychological impact of seeing a six-figure peso payout, right?
Yeah.
It distracts the micro-investor from the reality that their actual cut will barely cover a decent dinner once a year.
It's a massive amount of extrapolation. And here's another major mechanical question I had while reading this. They are selling these 0.75% fractions to individual retail investors all over the world via crypto. What happens if they don't sell all the fractions?
Ah, the underfunding issue.
Yeah, what if they only fund 80% of a room? Does a room just float there missing a wall?
The document actually addresses this directly, and it's a very clever, though highly risky, financial mechanism. There is a specific clause regarding underfunding. It asks the hypothetical question, what happens if there are not enough other owners to cover the cost of construction?
And what do they say?
The answer provided is, quote, if the numbers do not match to reach exactly 100% ownership, the remaining amount of ownership will go to the resort management, which will cover the remainder of the cost for construction.
Okay, so the resort management just steps in and eats the difference.
Yes. It acts as a fail-safe, and it speaks directly to the psychology of crowdfunding. If you're putting $350 into a Kickstarter or a new crypto project, your biggest inherent fear is that the project won't reach its funding goal, and your money either gets locked in some digital limbo or the project is just completely abandoned.
You just lose your money.
Exactly. So this clause is a psychological backstop built into the pitch to reassure hesitant investors. It says, don't worry, your specific fractional contribution isn't contingent on 1,000 other random people also contributing. We, the developers, will backstop the remaining cost out of pocket, and the project will be completed regardless.
It provides the illusion of guaranteed momentum. It says, we are building this train with or without you, but you probably want to buy a ticket right now to get on board.
Right, creating FOMO.
But mathematically, it means the developer is taking on a massive amount of unfunded liability if these crypto sales don't actually materialize.
Okay, so let's assume they build the room, they fund it, they launch it. Let's look at the long-term operational realities for the owners, the day-to-day survival of the resort. Starting with power, because running 24/7 air conditioning on a floating platform in the tropics is fundamentally difficult.
Providing reliable, high-load energy on offshore infrastructure is always the primary logistical hurdle. I mean, you are entirely off the grid. You can't just plug into a telephone pole down the street.
Right.
As the text notes, this usually implies relying heavily on diesel generators, which are incredibly loud, highly polluting, and exorbitantly expensive to run constantly because you have to ferry fuel out to the platform on boats. But Reef Resort claims they have solved this bottleneck entirely. They are pitching a massive solar-based energy production method, and they make a highly specific financial promise to the unit owners regarding this power. The document guarantees unit owners a flat 20% discount on the current market rate for electricity compared to the mainland city of Davao.
They are attempting to turn a massive logistical hurdle, off-grid power generation, into a tangible financial perk for the investors.
And they provide the exact numbers to back it up. The text states that at the time of writing, the average rate for electricity in Davao City is 19 cents per kilowatt hour in US dollars. So, with their guaranteed 20% discount, the locked-in rate for each unit in the resort will be exactly 15.2 cents per kilowatt hour.
It's a highly specific, granular metric that adds a real veneer of deep, professional operational planning to the pitch. It tells the investor, we aren't just dreaming about floating rooms with pretty views. We have calculated the exact per kilowatt cost of cooling them and structured a discount for you.
But, as always in this document, there is a caveat hidden in the details.
Always a caveat.
The text explicitly states, keep in mind that this rate applies only for solar electricity, while electricity produced by the emergency backup generator will be billed at a higher rate. Though they do quickly try to reassure you by adding, in most cases, these generators do not need to be turned on.
Which brings us crashing right back to the tension we discussed earlier between marketing promises and operational reality. Solar power is fantastic when the tropical sun is shining.
Sure.
But during a long, multi-day monsoon storm system, the exact kind of weather that might necessitate that preemptive evacuation we talked about earlier, the solar yield drops to near zero. The batteries drain. The emergency diesel generators have to kick on, and suddenly that guaranteed 15.2-cent rate just vanishes.
Yeah.
The owners are now paying an undefined massive premium to keep the systems running.
Exactly. And you can't just flip the breakers and turn off the power to save money because it's a fish and lobster farm.
Right, the livestock.
Tens of thousands of biological assets are relying on electric water pumps, filtration systems, and oxygenators to survive. If the power dies, the lobsters die. So the owners are absolutely on the hook for that premium generator power, no matter what it costs.
It exposes the inherent, deeply hidden risk of integrating a hospitality model with a live aquaculture model. The biological assets require constant, non-negotiable power. A normal hotel can survive a brief power outage. The guests complain, but the building survives. A fish farm cannot.
It's a totally different risk profile. Okay, so that's the power liability. Let's look at the perks. Why would someone actually do this besides the potential $28 a year return? The document outlines a few non-monetary benefits. Depending on what tier you bought, you get free stays. We saw in the chaotic pricing list that it ranges from 2 nights up to 10 nights, or maybe a full flat week, depending on which paragraph you choose to believe.
Pick your favorite list.
And if you own 100%, laying out the full $40,000, the text says you can rent it out privately, meaning you get exclusive, independent renting rights.
But the most important perk they offer, structurally speaking from an investment standpoint, is the exit strategy.
Right, because what if you get tired of owning 0.575% of a floating fish tank? The text has a whole section dedicated to this titled, Am I allowed to sell my ownership later on?
And their answer is a resounding yes.
Yeah.
The document promises that as an owner, You have absolute control and flexibility. You can sell your ownership to whoever you wish, whenever you wish, but they go a crucial step further than just allowing you to navigate the secondary market on your own.
Yeah, they make a pretty big operational guarantee here. The text states that, quote, at least once per year, the resort management will set terms available to all owners offering to buy them out, depending on the annual revenue of the resort.
This is a fascinating mechanism for providing liquidity. Real estate is traditionally a highly illiquid asset. It takes months to sell a house involving brokers, banks, inspections, the whole thing.
It's a massive headache.
Right. Fractional real estate can be even harder to sell because the secondary market is incredibly niche. Who is the buyer? Who realistically wants to buy 0.75% of a specific floating room in the Philippines from a random stranger on the internet?
Probably not a huge bustling market for that highly specific resale.
Exactly. So to combat the investor's fear of getting stuck with an entirely unsellable microfraction, the resort management promises an annual built-in buyout window. They are creating their own internal liquidity event. They act as the buyer of last resort.
The text literally spells out their philosophy on this. It says, this is to make it easy to get in and easy to get out based on what financial situation you are in at any time. The goal of this system is to make ownership of floating real estate as easy as possible.
And there it is. If we connect this to the bigger picture, that is the overarching strategy of the entire document distilled into one single clarifying sentence. Lower the barrier to entry to almost zero and promise an equally frictionless exit.
Make it as easy as buying a pair of shoes online.
Exactly. They are taking the psychological ease of trading a cryptocurrency token on an exchange where you can buy and sell in seconds with a click, and they are attempting to map that exact same frictionless experience onto physical floating infrastructure in the middle of the ocean. It is a wildly ambitious, perhaps mathematically perilous attempt to merge crowdfunding mechanics, decentralized crypto payments, and luxury ecotourism into a single cohesive package.
So what does this all mean? Let's take a step back and look at the whole journey we just went on. We started with this incredible utopian vision, a floating glass-bottom room where you can literally watch a massive industrial-scale fish and lobster farm operating directly beneath your feet while sitting in air conditioning. A place offering 360-degree views of mountain peaks, lush islands, and urban city skylines.
We examined the bold geographical defenses they claim, that situating a floating structure in deep water south of the typhoon belt supposedly makes them impervious to the devastating natural disasters that plague traditional coastal real estate. Even while, quietly acknowledging the absolute necessity of a preemptive evacuation plan when the weather inevitably turns.
We navigated that absolute labyrinth of fractional crypto pricing. The contradicting lists of one-time fees, monthly installments, fiat costs, and long strings of Ethereum wallet codes, all designed to allow anyone with a few $100 to call themselves a real estate investor.
And we broke down the precise yet highly optimistic return on investment calculations, highlighting the hidden costs of diesel generator power, the reality of a $28 annual return, and the promised annual buyouts designed to make the whole system feel liquid, safe, and frictionless.
Now, I want to remind you that our goal today was simply to decode this complex and sometimes deeply contradictory document. We aren't endorsing this investment. We certainly aren't telling you to go copy those crypto codes and buy a fraction of a floating resort.
No, definitely not.
But we also aren't dismissing the sheer innovation behind the idea. We are just here to impartially report on the mechanics and the vision contained in the source material they put out into the world.
It is a genuinely unique approach to hospitality and alternative finance. And it leaves us with something quite profound to consider. As coastal land around the world becomes scarcer, more heavily regulated by zoning laws, and infinitely more expensive, will this highly fragmented, crowd-funded model of floating real estate become the blueprint for future communities?
That is a wild thought. Could the next major human expansion happen not by building skyscrapers up into the clouds, but by floating out onto the open ocean? Entire neighborhoods and cities funded fractionally by millions of digital wallets, bobbing harmlessly over the waves.
It fundamentally changes what it means to be a property owner. When your foundation isn't poured concrete but liquid water, and your deed isn't a piece of notarized paper but a line of cryptographic code on a blockchain. The boundaries of what we can build and who is allowed to own it become as fluid as the ocean itself.
That is an image that is going to stick with me. We started today talking about the solid, poured concrete foundation of traditional real estate, and we've ended up drifting on the open ocean, holding a microscopic fractional percentage of a lobster farm in a crypto wallet. It's a brave new world out there. Thanks for taking the plunge with us.